You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs on the old network for you guys to choose from, including many, many archived hours and some great guests there on the old Volatility Views program, well over 100 at this point. Where can you find all of that great Volatility Views goodness, as well as everything else on the old network? Well, of course, the mothership, the flagship, the OptionsInsider.com. Surf on over there, click on the Insider Radio Network tab, and your adventure has begun. Of course, while you're there, feel free to surf around and check out some of the great articles and breaking news and all the other fun stuff we have going up there on the old website. And of course, if you want to find out some other platforms, we're pretty much wherever you find your favorite podcast programs: iTunes, TuneIn, Stitcher, even our mobile app available for the iOS, Android, and even the Fire OS store. So no shortage of ways for you guys to download or stream the shows. Then, of course, while you're listening, send us your questions, your comments, your feedback. We love to hear from you guys. And joining me on the old Volatility Views program today, my usual volatility compatriot, good old Andrew Giovinazzi from Option Pit, as well as good old Options Oddities here on the old Options Insider Radio Network. A lot of options in your title, Mr. Rock Lobster. Welcome back to the program, sir.
I was about to say you need lobster just to change things up a little bit, because there's options everywhere. Options Palooza, one might say.
One might indeed say that. Options Palooza. All right. Speaking of Paloozas, we got a Palooza of a guest today, a doozy, if you will. So without further ado, let's dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, welcome to the Volatility Viewpoint segment. This is, of course, the portion of the program where we bring on guests from throughout the world of volatility research and trading and analysis and proceed to pick their brains for the benefit of you, the listener. And today's guest is Scott Maidel. He is the go-to man for all things derivatives research related over there at FTSE Russell. Scott, welcome back to the program. It has been too long.
Glad to be here. Glad to join you guys.
And Scott, since it has been such a long time since your last appearance on the old program, why don't you go ahead and give our listeners a bit of a refresher on your background in the options and derivatives markets and how you found your way over to the research department over there at Russell?
Sure. So just a little bit of background there. So again, now of course Russell's going through a little bit of a split with the index group versus the investment side. So just clarification. So I actually work in the equity derivatives team at Russell Investments now, and been here for about six years, and prior to working for Russell Investments, worked at a boutique global macro manager called First Quadrant in Pasadena, California for about 5 years. And prior to that, worked at PIMCO in Southern California as well. So focusing on a variety of things, including derivatives research, primarily options, trading, and portfolio management. But lots of folks here, so I can really only claim to be the go-to guy for options, so to speak.
Well, you're our go-to guy, so at the very least, you can hold that title. And Scott, I know you have a lot of great research, a lot of cool products you want to talk about, but because we're recording this here on Friday, July 10th, it's been quite a roller coaster week from a volatility perspective. I thought we would start actually in a little bit more current neck of the woods. VIX Cash has been all over the place as a result of what's been going on in Greece. Volatility has been all over the place. We've seen a lot of interesting developments going on this week. Let's start out there in the realm of the titular VIX Cash. It has been kind of rocking and rolling of late. You know, we saw it languishing in the mid to low teens for coming into this week, of course, and then when all the Greek developments started unfolding in the marketplace, we saw it rocketing skyward, flirting with that so important 20 level, never really breaking it. I think it got to about 1976 or so on the upside there. And then today, of course, with the markets in rally ho mode, most of the major indices up well over 1% on the day. VIX Cash was selling off markedly, off about 3 handles at one point, down to the mid-16 range again. For those of you who love percents of percents, about 15% sell-off today. Getting some of that back now as the sell-off, as the rally, I should say, is tampering a little bit. But there's a lot in there, Scott, a lot to watch this week. Tell us your viewpoint. And did VIX perform perhaps as you expected going into this week and all the developments we saw unfolding? And were there any surprises that kind of took you unawares this week?
Yeah, it's a really good question you bring up, and I would think you can really kind of dissect that into really 2 components. You know, one is the volatility markets reacting to, you know, how one would expect them to react given the sort of the day-over-day moves in the S&P 500, and secondly, you know, is there any other kind of call it headline news? And you know, the way that we were looking at it here, and I was quoted, you know, in the media as basically saying, you know, basically there's, you know, volatility was pricing in basically, you know, a very binary outcome as far as like there either being a deal or not. You know, there was a lot of vol buying going on this week. VIX spot was up big. The term structure was fairly flat when you look at, let's say, VIX versus the VXV. And also the vol was very high. So there's a lot of people buying protection. You know, but in our view, you know, what we were looking at was the fact that, you know, we viewed, you know, VIX spot as being very high, term structure flat, you know, again, flat, vol very high, and relative to what the S&P 500 itself was doing, that in isolation, the volatility markets were very overpriced. Now, that being said, obviously, that doesn't take into account what's going on, you know, politically with Greece over in Europe, which is something, you know, those sorts of macro risks aren't something that you can always quantify based on some other types of moves, as in with the underlying equities. So that was our view. You know, we viewed vol markets being a bit overpriced, and so far, as of today, it looks like we're right. But again, that has some to do with just the political environment as well.
Yeah, it does seem like there was some healthy premium baked in there. Also, of course, looking on you know, the actual VIX paper we saw out there on the options, a lot of people had been loading up over the past month on July upside calls. That seemed to have been the trade du jour. Most of them in the north of 20 handles. So a lot of people either speccing on or hedging against a really extreme near-term move in the VIX. We saw certainly an extreme move, but nowhere near, you know, anything into the mid-20s or beyond, like a lot of people were suggesting. So I think you're right, Scott. I think a lot of the marketplace was perhaps pricing in or speccing on an aggressive move, and we certainly saw a very sizable move in VIX, but perhaps not as much as the market was predicting. I think the term structure is also an interesting point too. A lot of people might expect, you know, the near term of that term structure to get kind of wild and woolly in an environment like this, and we didn't see that as much as perhaps you might expect. You mentioned also the vol of vol. That's something we talk about a lot here. Products like VVIX and others are good kind of indicators of that. VVIX, of course, having been on the rampage of late. It was vacillating in the lower end of its annual range, down around the 80s, until coming into the Greek crisis, kind of setting off again. Tell our listeners a little bit about how you incorporate, vol of vol and things like VVIX and others into your analysis. And, I know a lot of people, that's a big crux of the analysis. Is that a lot of the work you do over there centered around the vol of vol itself?
Yeah, absolutely. And, it's probably one of the more interesting topics when you talk about kind of the things like such as the VIX or term structure of vol of vol. When you talk about where the vol of vol recently was, as far as kind of the recent high was around 115. As of today, I think that's kind of come down, kind of fluttering around maybe 105, so it's down around 10 points. But really the point is, when you go back and you look at the longest term history that you can for this specific index, the VVIX, you've seen it kind of top out around 140. And anything over 100 and especially 115 seems to be very high. So the fact that the market itself, meaning the S&P 500, for example, was only down a couple percentage points off its high, a few percentage points off its recent high, and the VVIX was already at 115, it really tells us that there was a lot of folks out there spending a lot of premium buying VIX directionality. And when things get that expensive, it just, unless you do get that really big move in VIX spot in those first month option contracts, the first month futures contract, it's really difficult to make money hedging. You really have to have an extreme outcome. So I think it comes back to really, there's a lot of folks out there speculating on really the worst case outcome and willing to spend very, very rich, expensive premium money on buying directionality.
Yeah, you mentioned the volatility premium, the risk premium in the marketplace. That's a frequent topic of discussion for us here on the show. Of course, the implied volatility versus the realized exhibited volatility in the marketplace. But again, that's a big focus of what you guys research and what you personally work on over there at Russell as well. So why don't you give our listeners a little bit of an overview of how you factor in that risk premium as well, and how you factor that into your models, and what you use that for as you're setting up your research and putting out your research to clients.
So good question. So this is always really the starting point when we're talking to any sort of client, whether it be retail, registered investment advisor group or an institutional pension endowment or foundation. It always starts with, let's gauge where they are with their understanding of not just, let's say, the VIX, because volatility goes far beyond just simply looking at something like the VIX. So the way that we like to break this down is really talking about four things. And of course, it does start with the implied to realized vol. So we are looking at the VIX relative to a trailing, let's say, 20 and 30-day realized volatility level, for example. But it doesn't just stop there. We also do look very closely at volatility skew. Understanding the volatility levels associated with those downside puts, and then thirdly, moving on to term structure, we look at things such as the VIX to VXV, the VIX to the first month VIX futures contract, and the first month futures contract, relative to others out on the curve as well, to understand what does not only the S&P term structure look like, but also what does the VIX futures term structure look like? And then lastly, as we already talked about, just understanding what the VVIX or the vol of vol, where that's pricing, because, it's one thing to be right on direction, but if you're overpaying for, option directionality, you may not make any money. So understanding those four things and how they commingle in with each other as a starting point to discuss strategy is really step one.
Now, just as an aside, you mentioned you're talking a lot with clients and you're trying to gauge their level of knowledge in the space. That's kind of a common refrain we hear from a lot of specialists in the volatility trading realm, particularly if you're looking to grow a fund or something like that, that a lot of the traditional users or investors in a fund, the pension funds, the hedge funds, the endowments, whatever, they don't really, still to this day, have a strong understanding of these things you're talking about here, things like vol skew or term structure, or even more basic things like hedging or just anything that uses the dreaded D word, derivatives, they tend to shy away from. I'm curious, as someone who interacts with a lot of these different clients on different levels, have you seen that overall level of knowledge and perhaps even acceptance of these ideas and these strategies? Has that been increasing in recent years? Do you think we're kind of at a plateau, or what's your viewpoint on that? You think more people are coming on board to the need for and the use case for these types of strategies?
Yeah, absolutely. I would say that the knowledge base has definitely gone up. I think the interest is still only increasing, and I would definitely say that looking forward, I can only see how these markets would continue to grow. And, the knowledge base will continue to increase because, it's not just all about, some people may be skewed one direction or the other as far as risk seeking versus hedging, for example. And it really depends on where you're coming from. If you're a pension fund that's fully funded, you may only be looking at, hedging opportunities because for you, for some chief investment officer, running a fund, a pension fund, you may be only concerned with that funding level. However, there's also plans that are truly more risk-seeking. So it really is a two-way market. So we do see a lot of increased demand for both education as well as making steps towards, actual implementation. And it has been a really interesting environment for both of those camps, because when you look at where the underlying equity markets are, investors have seen some really fantastic gains the last few years. So you have, quite a few folks looking to, to hedge their overall portfolio, but you also have, a lot of folks looking at, forward-looking returns in the market and saying to themselves, well, how can I diversify my risk? How can I diversify into something that can have the potential to make money, not only in a sideways market or a relatively disappointing forward-looking market return environment, if that's your view, not only in those two sorts of environments, but also in environments where perhaps the market does go through some sort of soft correction. And that's where the risk-seeking volatility strategies, being the insurance provider, really comes into play. So I'd like to talk a little bit about that, if you don't mind, as far as, the way that we look at constructing a more efficient portfolio.
No, that I think a lot of our listeners will find that very, very valuable. Go ahead.
Yeah, so, the way that we like to look at it is, it's not just about, obviously there's a variety of things you can do, and it's not just all about call overriding or put writing, or let's say like selling the front month VIX futures contract, for example. And, some people like to trade the XIV, ETN, and so on and so on. The way that we like to look at it, and what we offer is something that we call a multi-strategy volatility portfolio. And what that is, in the most simplest way to describe it, is really 50% equity index option-based strategies and 50% VIX-based strategies. Drilling down a little bit further, the equity index-based strategies is basically a traditional variance replication using equity index options as well as futures. And on the other side, with the VIX components, it's really using VIX futures to efficiently trade the term structure, as well as using VIX options for twofold. To one, basically in a hedged manner, trade the VIX term structure using VIX puts and calls, as well as lastly using VIX options to trade the volatility of volatility. Things such as traditional selling straddles versus VIX strangles, for example. So when you take each one of those components and you combine them together in a portfolio, what you have is a much more efficient way to gain exposure to a small basket of volatility strategies than simply just relying on, let's say, the VIX futures term structure, the traditional, short VXX or long the XIV approach that so many trade.
No, I was just back to the comment, earlier about what I thought was funny of the last 2 weeks is that we had volatility. Let's say the market was more orbiting in price. It wasn't necessarily going straight down. It would drop down and then pop back up and drop down and pop back up, which probably kept a lid on VIX overall. But for the most part, it traded around like 17%, and then it shot up to almost 20 yesterday. So we had some, I'll just say, we had some solid, let's say, orbiting movement, like average true range. Those numbers were a little bigger. But obviously VVIX was pricing, or volatility of VIX was pricing something a lot more. And I'm starting to think that, I think people are getting a little savvier. You were talking about, different combinations of strategies. And I think people are getting savvier with the vol products that they've been burned so many times just by buying vol and then having nothing really happen. And the volatility craters, I think now they're a little smarter where they buy underlying and they buy some VIX calls, or they do something where they actually try to play a little bigger game on the realized volatility. I mean, that's normally what I do anyway, but where you're trying to use the vol products to sort of hedge maybe a long equity position. And if you get that binary or parabolic move either up or down, which it looks like we're getting right now as the market is looking at highs of the day. I guess some Greek news came out, but you have these events where all of a sudden, and I think it's part of because the Fed has stepped in, where we used to get a bounce. We have a sell-off and then we get a bounce, right? And now when the Fed had been stepping in with all this liquidity, the crashes were happening on the upside, where you had this 1.5–2% up days, which were,
Mm-hmm. Yep.
I never remember those happening when I was a floor trader. I probably wouldn't be here today if we did, because I used to sell a lot of calls back then. I don't really do that too much anymore. So just, I could see, it's when you're saying, you were talking about different pieces of volatility, and then you've got like China, where the moves per day were like 4 to 5%, which is like almost 75 vol. And the market there was only pricing like 50%, at the money. So you had a lot of, there was, without Z stepping in with, that was going to be my blog today. Instead of, there used to be the Greenspan put, well, now it's the Z put, where if you short stocks, they're going to throw you in jail, right? That's a way to kill the vol right there. You're not able to sell anything anymore. So I thought we had a lot of vol. We definitely had like streams of volatility moving in different directions, where the Chinese market was beyond volatile by any stretch. And that's a pretty big, and we pushed that away for a long time. It really didn't show up until like, a couple days ago. And then you've got Greece possibly exiting, which nobody, the market never prices uncertainty well, I've found, where they don't know what's going on, so they just jack everything up because all the sellers go away. So, it was hard to like pick vol to sell. Like if you went out and you sold, let's say, calls or call spreads in VIX, that was still a tough strategy, because you could walk in and then for down 3%, where's VIX? So it wasn't easy to sell vol this week.
I absolutely agree with you. It is, it's one of those things, and just kind of some random points I'll bring up. Sunday night when I was looking at the S&P, futures down only 80 basis points or so, I also saw the front month VIX future up 2 points. So, big moves in both VIX futures up and the vol this week on very light, very modest, S&P downside. But you're right, investors have gotten conditioned the last couple of years to, very, very aggressively buy the dips. And we saw a couple attempts at that this week, and it just, reversed the next day. So it became very clear that if you were going to, establish positions, you kind of had to, like any good trader would do, you would sort of leg into a third, or a, fourth by four, and really pick your points, because, there was still a probability that perhaps Greece did do the Grexit that folks were talking about, but doesn't necessarily look like that's going to happen. And, it looks like they played a very good, card game of, where they were bluffing. And at the end of the day, they had to fold.
Yeah, they got a little bit. I guess they got the French to write the deal and not the Germans. So it was easier to sell till they got something. And they'll probably do a haircut on their debt at some point, I think. But, they're never going to pay it back, I guess, if any of these countries are. But now all of a sudden it's like now I'm looking for the next leg for the market to go up and where vol could go right now. I think now we're moving so far so fast today. I'm just looking at all my positions here as I move around. It's almost like the VIX Cash can't go down anymore until we stop, screaming up, because we're kind of in that weird phase where we're rallying so hard it's hard for volatility to go down.
Yeah. Well, we've been stuck in kind of a choppy sideways market for much longer than I think anybody anticipated this year. So, I'm hard pressed to believe that will, stop anytime soon. The default, I think, would be that we're probably going to be stuck in still a range-bound market. Right here where we are in the S&P, we're kind of right in the middle of that. So, that could be something to think about as far as that goes. But, even if people are just thinking about putting on new positions as of today, I think you have to kind of have to take a step back and look. It would still probably be a good long-term opportunity to sell vol here, and if you're on the side where you trade only the ETNs and ETFs, for example, it's probably still a good day to buy the XIV. But if you're a long-term sort of investor, you're looking at volatility from a risk-seeking approach, where what I mean by volatility is like pure vol, as in volatility carry. So if you are looking at something like that, it's really a long-term play.
Scott, I know we're running short of time here on the segment, but there's a few other things I wanted to hit on with you really quickly because they're certainly top of mind for me, as well as I'm sure a lot of our listeners. One of the reasons we wanted to have you on the show, and we had you on the show initially, was, Core, I'm trying to think the first time I came across your research, and it was probably about, I think, a few years back at a SIBO event. And one of the things that caught my eye is you were presenting on the different returns, the efficacy of different approaches on the volatility selling side, in particular the premium harvesting side. And you were one of the first people I saw to really break it down across a variety of different terms, obviously annual and then quarterly and then monthly. And at the time, the weeklies were kind of a nascent addition to that. You didn't really have a lot of data on them. They weren't the gangbusters hit that they are today. So clearly that research done today would be a little bit differently because the weeklies have changed pretty much everything. The landscape of how options trade, how decay performs, and all these other things we've seen in the wake of just the weekly explosion. So I'm curious if you have any updates on that research that incorporates what we've been seeing in the weeklies, and have they made any interesting impacts on the way that performance plays out across the different product categories?
Yeah, it's a good question. It was interesting because when you look at 2013 and 2014, we had mentioned earlier that, the market went through this phase where, the velocity of the upside moves were actually at times greater than the sell-off itself, which is something very, very rare historically. So you basically saw not only moderate, or normal, call it, depending on who you're talking to, perhaps they call it moderate panic selling or just selling period. you not only saw that, but you also saw routes of just panic buying as people wanted to get back in. Something very, very rare. So if you were someone who was writing weekly or 2-week options as well as monthly options, the strike selection really came into play the last couple of years. So, on an absolute return basis or on a standalone basis, the performance may have looked really good because obviously the market continued to go higher, and if you're doing stuff like call overwriting or put writing, still generated good returns. But when you look at those returns relative to something like the BXM, at times they tended to lag quite a bit because as you would restrike your weekly or 2-week options, for example, during those market troughs, you still weren't getting paid enough premium to overcome the massive snapback rallies that we experienced. So we still continue to think that using a diversified, overlapping tenor approach is the best way to go for risk premium strategies, whether it be overwriting, put writing, or what we're doing in the delta hedged strangles and straddles, for example. It just makes more sense to diversify and overlap that risk than to simply choose one point in time per month. But lastly, I will just say you've got to take into account, of course, if you're benchmarked against any specific index like the BXM or the BXY or the PUT index that the CBOE publishes, then you have to take that into account as well.
Of course, since we're talking weeklies, I'd be remiss if I didn't bring up, we have a clear launch date now for the weekly VIX products. It's going to be July 23rd, so coming up here in a couple of weeks. I'm curious what you feel the impact of those products will be, if they'll be, have a big demonstrable impact similar to other weeklies, or, we've seen also some recent forays into near-term, short-duration volatility products like VXST kind of wither and die on the vine, not really get any traction. So I'm curious what your viewpoint on these products is. Are you excited by them? Think they'll be a compelling addition that will generate a lot of traction and certainly for you a lot of research opportunities? Or you think maybe we're looking at potentially another VXST that gets a lot of news when it launches and then kind of withers and dies on the vine?
Yeah, it's interesting. I'm actually very surprised that the VXXT didn't take off, but at the same time, when you're a pension endowment foundation, investor, or you're a real money manager it does take time to adopt certain trading instruments. It's not for most folks it's not overnight or in even a short amount of time that we can actually implement certain types of trading instruments into funds and so forth. You have to go through, make sure it's properly documented in prospectus and so on and so on. That being said, though, I think that the weekly options in the VIX are just going to absolutely take off. I don't see it being, I don't see it being a disappointment like the VXST. I think you're going to see huge volumes in the weekly VIX options, and bravo to the CBO for doing such a great job with launching those. Yeah. One last thing I will mention, though, we do plan on using the VIX weekly options in our pure volatility fund. Would be remiss not to mention the RIC4 multi-strategy volatility portfolio. It is a UCITS fund. We are looking at this in a variety of other regulatory environments for launch, perhaps elsewhere. But again, this is a UCITS fund just north of 300 million. So, we just started this in January, so we're pretty happy with where that is. And we will be using the VIX weekly option.
Well, since you mentioned the upcoming and the new Russell products, I'd be remiss if before we left I didn't give you a chance to at least tease our listeners with not only some research you have coming down the pike that may interest them, but also, and I've been talking to a lot of guys over there at Russell, Pat and others behind the scenes, and they've been dropping hints to me of a lot of very interesting stuff coming down the road from you guys from a volatility product perspective. So I'm curious if you could perhaps leave our listeners with any hints. And of course, if you want to announce anything here, feel free. Go ahead, sir. The floor is yours.
Sure. Yes. So again, just for those folks who do have access to, invest in the UCITS products, we did launch the RIC4 multi-strategy volatility portfolio in January of this year. So that's relatively new. For folks in the U.S., if you're a RIA or retail investor, we do have the RIC call overriding fund, and that's just under 100 million as far as the AUM goes, and that's the fund where we use the weekly, biweekly, monthly diversified call overriding approach. So as far as funds go, that's really the main two funds that we'd be focusing on, for the listeners. And of course, we do run a variety of separate accounts if anybody's interested. So I would just say reach out and let's have the conversation.
And where should listeners go if they want to learn more about all these compelling funds you're mentioning here?
Sure. No, I have no problem. Yeah, anybody can reach out to me directly. I'm always happy to make a new contact and have some good discussion and debate. My email is smaidel@russell.com. That is SMAIDEL@russell.com. Or you can call me at 206-505-4923, 206-505-4923.
Well, there you go, listeners, your personal gateway to all things Russell volatility research. Scott, I'm really glad we can have you back on the program. Certainly, there's a lot more we can talk about. We'll have to bring you back on again down the road to dive into a bit more of how these products you guys are launching, as well as the funds, as well as how some of these products like the VIX Weeklies and others are unfolding in the marketplace. There's a lot of stuff for us to discuss. So thanks again for coming on, and we'll look forward to checking in with you again down the road.
Thanks, guys. Appreciate it.
Thank you.
All right, and now we'll keep on rolling with the program right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is indeed the portion of the program where we break down what's moving, what's shaking, what's happening from a broad volatility perspective. And Andrew, we covered a lot of ground there with Scott already. We'll just hit on some of the other finer points. Of course, while we were recording the show, actually, right going into it, we had the Fed coming out and Yellen saying they do plan to raise rates sometime this year, probably by a piddling amount, somewhere around 0.25% or so. And the market kind of just shrugging that off and saying, yeah, it doesn't really mean a lot to us as the rally continues. Most of the major indices now up over 1.3% on the S&P, the Dow up 1.2%, the NASDAQ leading the charge to the north, up nearly 2% at this point. And the sell-off once again resuming from a volatility perspective. We're getting down to the off three handles portion that we were trading at earlier. We saw a bit of a tempering in the sell-off, a bit of a rally from a vol perspective. All of that now going the wayside now as the market's just saying rally ho and beyond. So Mr. Rock Lobster, like we were saying at the top of the show, a lot of stuff to digest, a lot of interesting developments from a vol perspective. What really caught your eye in the yin and yang that was vol this past week?
Just a crazy week from a vol perspective. It was all over the place. I mean, Scott made some points about I think vol was real expensive because people are tired of not being long when it bounces. So I think they're just buying vol products and trying to pick their entry spots. You had volatility in, probably the biggest market in Asia at 75%, day to day. Realized vol nuts. So there was plenty of volatility to go around this week. So as I said, it was hard to sell. It was hard to sell volatility product vol with the Greece exit. It looks like they're going to sign a deal and everything else because it's so easy for the market to open down 2 or 3% and then vol's 30. It's just VIX is 30. We've seen that before. People hate getting drilled by that. So I think there's a point where even when VIX is 18, and this is what I coach some of the pro traders we have and our other people, like when VIX is 20, it doesn't mean it's underpriced. It just means there's a lot of volatility. And you got to be careful how you sell it. I think right now, and I think because the Fed is really leaving the active part of the market, as far as, they're done, right? They're going to stop. They're going to start raising rates. They're not buying any more bonds. They're not doing any of that crazy crap. Everybody's just on their own. So I think we're back to kind of more normal equity returns, which means to me it's iron condor time. I think the strategy that's going to make money in 2015 is the iron condor, something like that, where you just sell those out of far-term call spreads and put spreads, every time the vol pops a little bit, because, things are just not as bad as they were, and you get by this, you get by Greece, and, the Eurozone pokes around for another 3 or 4 years while I try to get their act together, but those big macro things are not looming as bad as they were before. So, I wouldn't want to be holding on to any of the vol products right now. Never know what will happen this weekend in case there's some way out of left field surprise. Because almost every day we've had a rally in the market and then a crash in the vol products. Literally, that has reversed on some other, on some other thing. So, I mean, the Chinese market would have stopped going down at some point. It didn't look like it was going to stop until the premier stepped in. So is that good long term for that market? All I know is I've always been kind of a black swan trader anyway, kind of, you're short a little bit of near term gamma, but you always have some protection in case anything really goes nuts. And I just think that black swan case is only going to get larger as time goes on, unfortunately. I kind of wish they would have let just the Chinese market tank a little more and just the natural buyer step in. But
are you saying yesterday's biggest one-day move in nearly 6 years in the Chinese market was somehow due to the fact that they effectively banned selling? You're saying it wasn't a natural...
Or they throw you in jail.
It wasn't a natural rally. It wasn't more buyers than sellers. Well,
no,
it literally was.
It
literally was, but not through any economic incentive or motivation.
Yeah, they're just going to throw you in jail, right?
That's one way to do it. If you sell those stocks, you're out.
Yes, we're going to electrocute you. Whatever he said, and to be, and they had so tried to control that equity market for so long. They had shares of different classes, and they were creating all kind, and they were creating issues in their own markets naturally, like things get traded at Hong Kong or Shanghai, and only certain people can invest in this and that, and they had to blow that dislocation out at some point. And which looks like has happened because everybody just said screw it and sold everything. So, and then you get to start 2014 all over again at the same place where, or 2015 all over again if you're a Chinese investor.
This is a refrain, not to make it into the Asian Tiger podcast, but this is a refrain we've been hearing from the Chinese bears for years now, that all their banks are insolvent by Western standards and their companies dubious accounting and et cetera, and it's kind of just the markets over there are just moving north through sheer momentum, if not manipulation on the part of the government, not through any real natural recourse, and if left to their own devices, these things would tank and the economy would crumble, et cetera, et cetera. Perhaps we saw some shades of that over the last few days before they came in and said, yeah, if you do that, you're going to jail. So that's one way to turn around a sell-off. I like that. I give them points for just going for it.
They said just, what? The heck with it. You go to jail and that's it. They pulled the biggest card they could pull, which I thought that was pretty
Imagine if Obama came out tomorrow and said, if you short IBM, you are going to jail. Can you just imagine?
Well, they did that in 2008.
Yes, it was a little bit different case, but they kind of just banned it outright, which is they didn't say you're going to jail. That's kind of really made it impossible to do. But yeah, that lasted, a weekend or two before they came to their senses. But still, interesting stuff. We'll pull it back away from the Asian Tiger podcast. We can go down that road for quite a while. As you mentioned with Scott at the top of the show, then, of course, things like VVIX have been vacillating all over, coming off its highs, hovering right around 115 or so right now. So still still some vol in the marketplace. Interesting, though, the skew index, perhaps not too surprising given the fact that we're in pronounced rally mode, kind of near the lower end of that 1-year range, hovering around the 120 out there in S&P, showing that despite what you were just saying, Andrew, about the pronounced, perhaps potential, the growing, looming potential for that oft-used cliche, the black swan event, and the fact that we're hovering around some pretty record levels in a lot of the indices, still the desire to hedge aggressively, not really there right now out there in the broad marketplace. Speaking of hedging, we talked about a little bit with Scott, but one thing interested me this week, Andrew, and I'm curious if it caught your eye as well, is, we've been talking a lot on this show in recent weeks about how all the paper out there in the VIX side has just been buying July calls, buying the 23s, 26s, sometimes verticals if the guys are a little bit savvier, sometimes vertical ratios, not too often, but still the lion's share was just July call buying for the most part. So people were loading up on expecting something pretty sizable in the near term out there in the VIX land. As we mentioned, the call to put ratio got pretty heavy at one point, got up to close to 4, which is pretty much pushing record territory. And as we're recording this, it has come off a little bit, only about 3.2 calls over puts, which is kind of what you'd expect given the rally. People will be dropping off some of those positions. But what surprised me is that there wasn't a lot of that call selling out there. A lot of people are still holding on to those very aggressive calls they were buying out there in the mid-20s, if not higher, in the July call range. A lot of those positions are still open. We did see a few sizable call sellers. I saw one guy legging into about 40,000 of the July 30 calls. He sold them, I think, on splits for around 22.5 cents. That could be a straight-out sell. Probably more likely one of these other guys who had bought, let's say the 23s, maybe legging into a vertical for even and probably getting that spread off for a decent level there. But other than that, we didn't see a lot of people coming in to really aggressively dump the July upside that they had gobbled up en masse. So kind of interesting. People obviously still perhaps in their back pocket concerned about something, or just not finding a reason to pull the trigger and dump those when the VIX Cash was hovering around the 20 level. Did that come as a surprise to you this week, Mr. Rock Lobster?
I was channeling Scott. I think people are getting smarter about how they trade VIX because they've kind of probably got slapped in the head so many times with it. They're all looking for that 2008. That doesn't really happen that often. Once every 10 years or 12 years or something like that. Where you get the vol really blows up like that big. Most of the time, you get those small runs. And I think they're spending more time. They're buying a bunch of VIX calls, and I think they're buying a little bit more increasing equity exposure. So when you get the bounce, they make some money. You lose some money on your VIX calls, but you make a lot more on how long equities you are. So I think they're getting a little savvier about how they go about using the VIX as a product, and that's what that's what we talk to our clients about, and how you use the vol products. There are ways to use them that they work really well, and there are ways to use them where they work really bad. What's funny is the VXX and some of those ones that are always around, they work really bad for what they were designed for. Or they actually do exactly what they were designed for.
Yeah.
So, but that's a good thing, I think. And VIX does what it's designed for. I mean, it's an option on a future. And if you don't understand how to trade the future, or, when Scott was talking about the term structure in the futures, you're asking for trouble. So, I mean, we had a lot of huge open interest, a lot of buying. And I think even with the crush today, you've got a almost 1.5% rally. So that's a good, I think for if you own some underlying that, overall it probably worked out okay.
I didn't get a chance. You mentioned the VXX performing poorly. I didn't get a chance with Scott, or we kind of ran out of time to talk about some of the ETF products out there like VXX, but probably more salient, the VIX up, VIX down, get his opinion on that latest hot piece of volatility product action out there. Of course, it's been an interesting week to watch that one as well, with the VIX down, of course, leading the charge today, as you might imagine. Even still, a day like today, Andrew, I think a day that you'd think a product like VIX down was ostensibly designed for. VIX Cash off 3 handles, a product that's trying to trade VIX spot, to the downside, this would be a no-brainer. And it's done 9,000 shares today. That's it. I'm curious what's your take on these products. I haven't had a chance to really gauge your insight into them in a couple of weeks. What's your take on their performance versus what they're claiming to deliver here?
Well, let's see. You got VIX down in percentage terms, which Mark's love, was 16%, and VIX down is up 3%.
Yes.
I think. When you're a trader, you would trade those issues, you would call them roach motels, where traders check in, but they don't check out. And I'm having a strong sense that that's what these VIX up and VIX down there. I think as a real product, since they're so unpredictable on how they move, that makes them useless. So that's what I would call these. I'm sorry, but they're useless.
I'm looking here, and even on a day like today, VIX up still leading the charge from a volume perspective, almost 3x, about 25,000 shares having gone up so far. So I kind of hard to really make heads or tails of what these things are. And you're right, on a day like today, when they're supposed to be delivering spot, if you're coming to it for a spot move, you're not exactly getting what you're paying for here from an overall vol product perspective. We're kind of running up against it, so I think that's where we'll tail off the old volatility review for right now. All you guys who wrote in, I'm sorry we went a little long with Scott. We had so much good stuff to chat about. We'll get to your questions next week. In the meantime, we're going to keep on rolling right on into our final segment. Yes, it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball segment. This is the portion of the show where we go hog wild from a vol perspective and prognosticate recklessly and indeed wildly on the future of all things volatility. Andrew, we're at a bit of a precipice here. The market having a rally, then kind of giving some of it back, now rallying again. Volatility taking it on the chin. We're back into the 16 handle as we wrap up the show here. So over a 3 handle sell-off, pushing a 16% sell-off for the percent lovers out there from a VIX Cash perspective, and just a very, very pronounced sell-off. Of course, we do have earnings season on the horizon. Perhaps, if all things said and done, the Greek thing perhaps tending toward the rearview mirror. Of course, that's not certain yet. We also have the Fed coming out and ostensibly laying out their groundwork or their ground plan for the rest of the year, ostensibly. So that's kind of shifting into the rearview mirror a bit as well. So it's kind of an interesting point to be prognosticating about volatility. The Greek thing could take a turn for the worse again. Of course, we could be back pushing that 20 handle from a VIX Cash perspective again sometime soon, or we could be the beginning of the doldrums, the dog days. The earnings season could be a bit of a bust, and we could be back down to the low end of the teen range from a vol perspective. It wasn't that long ago, I think last time you were on the show, Andrew, we were prognosticating whether we might see a 9 handle in the VIX Cash sometime soon. So who knows? We might be seeing an aggressive swing to the downside. Where do you fall on that kind of binary outcome choice?
Well, if the Greeks sign and you're going to jail for shorting stocks in China, it would not surprise me at all to see VIX 14.01 by Wednesday or Thursday next week.
So you're backing away from your 9 handle prediction.
The 9 handle, we're not getting there this next week. We've gotten, I think we scared the 11 handle, I think, a little bit. But that was like 3 weeks ago. So
yeah, it was a while ago, yes.
With people feeling they don't need the Fed in the economy, and if you could get some of these like kind of macro issues squared away, that's how vol gets real low. When there seems to be a more clear path of, even if nothing's exciting is happening, that usually means that that puts volatility in the dirt, because stocks are back to moving at what I would say just more historical types of realized vol, like 6, 7, 8%, something like that. Market's up a little, down a little, and people aren't freaking out about it. So, And we've just, if you look at a chart of volatility where it was 2 weeks ago and, where it is right now, it is not difficult to believe that you could see, much lower numbers for volatility, within a week or two, if nothing really happens. So that's kind of what we're setting up for at this point.
Yeah, we've last flirted with the 11 handle back on June 23rd. So a few weeks back, we hit 11.93. And I was mistaken earlier when I said I didn't think we crossed the 20 handle in VIX Cash. We actually did just ever so briefly cross it yesterday, actually hit the 20.05 on the upside. So I thought it was 19.97, but that's where the close was. So a few ticks north of 20 ever so briefly before we gave up the ghost. So interesting stuff. Unfortunately, it's all the time we have for the Crystal Ball segments, also all the time we have for this episode of Volatility Views. Of course, I want to thank our guest, Scott Maidel, who is on the equity derivatives. One more time for me. Of course, I want to thank our guest, Scott Maidel, who's on the equity derivatives team over there at Russell Investments. Certainly our go-to guy for all things Russell volatility research. And of course, before we go, Mr. Rock Lobster, what's cooking in the land of the pit?
Well, something that has to do with actually, when we will talk about time spreads and volatility products. On the 18th of July, Mark and I are doing a 3-hour webinar. It's going to cost you money, but I guarantee you it will save you 20 cents on a 10 lot, and you are already actually not even that much. It's or it's $2 on a 1 lot or 20 cents on a 10 lot. Take your pick. That's the cost of our webinar. Pretty inexpensive. Understand how time spreads work. So if you want to trade them, you should know how they work. And no place better than I can think of than to come to Option Pit to one of our webinars and do some learning. So that will be next Saturday. And if you just become a gold member at Option Pit, you get all of our weekly webinars for free. So it's like you get a year's worth of webinars for nothing. After, of course, you give us some money for the gold course.
Of course. There you go.
Of course.
Once you get the money, the rest is all gravy, right, sir?
Exactly.
All right. Surf on over to optionpit.com to register and learn more. And of course, while you're surfing, make sure you surf on over to russell.com. Check out all that stuff. Scott was talking about the funds and indeed the new volatility products that they're hinting at over there. I can't wait to dive into those a little bit more and perhaps break some news on those in the show in the near future. And on behalf of Andrew and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. We'll get to them next week, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/the The Options Insider or via questions@theoptionsinsider.com.